I welcome everyone to the 28th Annual Beard Group Distressed Investing Conference. This is the first and therefore the longest running distressed investing conference around. And the conference has been sort of a labor of love for many of us over the years in the industry, where we get together and have great panels, do great networking, and a lot of good schmoozing with each other. The conference was virtual last year, as many of you remember, and this year we again are able to have the intimate in-person conference that all of us have grown to love over the years. Having said that, this year's conference continues to be the high star quality level, and in some ways is better than ever. A lot of the credit and luster goes to my co-chair, Josh Sussberg, over here of Kirkland & Ellis, who again had a banner year at the center of the restructuring industry. The conference is a full day of all-star panels moderated by some of the best mainstays and some of my oldest friends in the restructuring industry, so it's really a coming home. I would recommend everyone look at the conference agenda. It's really great this year. We're going to start with the year in review and a look into 2022 with our longtime friend and distressed investing guru, Steve Gidemo of Virtus Capital. Then this morning we have 3 sessions in rapid succession: liability management and litigation, real estate valuation in the face of the global pandemic, and distressed investing in Asia. We have our annual Harvey Miller annual awards luncheon, and then this afternoon we have more great panels on distressed hospitality, challenges for independent directors, distressed healthcare, and the annual distressed investing panel. As the conference culminates late afternoon, early evening with a turnaround and workouts outstanding young restructuring lawyers reception, which is always a highlight. Every year the conference mission, overriding mission, is to ask where we've been and where we're going as an industry. Last year we got to talk about how there was a plethora of oil and gas and retail cases, multi-billion-dollar bond defaults like J.C. Penney, Josh's case, Chesapeake and Hertz, and how their cases were filed in Zoom more and more in Houston and a couple of other places like Richmond, Wilmington, and New York. And we increasingly looked at the increasing level of heavily negotiated deals pre-filing, leading to pre-negotiated or pre-packed cases. This year, almost everyone I talk to says we're a little bit less busy than last year. We blame the government for pumping too much money into the system, and we're not really sure a lot of us are not really sure where things are going. If anything, in my view, the lesson of the last year, as I've told everyone, is that the old Chicago saying is true: no one knows nothing about nothing. However, there are some people around who I at least assume know a lot more than I do, and many of the others. And at the top of my list is Josh Sussberg here, who's been at the center of so many of the major cases from his perch at Kirkland & Ellis. So I thought probably the best way to start the conference is to put Josh on the spot and ask a couple questions and see where he thinks the industry is going. And among those questions, I would just throw things seem to be relatively slow to many of us. Is that the case? Why is that? And what do you anticipate an uptick? Second, what sectors of the industry and industry sectors are likely to be the most active going forward? Third,
let's do it one at a time. I'm not going to remember.
Oh, okay. Well, that's why I asked you if I should read them all at once or whatever.
No, that's
okay.
That's
okay,
right.
Josh, what's your name?
I know nothing about nothing.
Okay.
I don't want to steal Stephen's thunder here, but I think it is definitely a slowdown from a restructuring perspective, without question, and that's just clearly the result of the government putting substantial funds into the economy, and it's somewhat of a tale of two cities. I think from a restructuring professional's perspective, March of 2020 when the economy crashed and the markets crashed, we saw an uptick in activity like I don't think anyone has seen for a very long time, and that lasted for a good 5 to 6 months. And I think it's telling because when you talk to people that are on the M&A side of the house and private equity, deal flow had slowed down for a couple of months. And there was an uptick in late 2020 because of the government stimulus. And that corresponded directly to a kind of downturn from a restructuring standpoint and a lot of companies being able to access lifelines and being able to get financing that otherwise was not available. And so I think, from a seesaw effect, what you saw in 2020 was just a massive amount of activity that's been followed by the last 9-10 months of a slowdown because of the government's availability of funds for various companies in all industries. And I think, Harold, you mentioned retail and oil and gas. Restructuring professionals from 2015 until recently had spent a lot of time in retail and oil and gas. And I think what you're seeing now is, no specific industry per se that has a lot of distress, but it's pockets and ones and twos in various industries. Oil and gas and retail have worked through. Retail has been an incredible slowdown because of the bounce back, because of the government funds. So, from the perspective of what we're going to see going forward, I think it's going to be very mixed. There's going to be some healthcare restructurings. There's hospitality. Lorenzo's going to talk about that today. And from a retail and oil and gas perspective, there's always activity, but I think it's much less pronounced than it had been.
Okay.
I don't remember your second question.
Oh, you answered 2 already.
All right.
Then
good.
I get to the third. One of the things that I think we've all seen as a trend, and particularly as a real kick up even this year, particularly from your firm, is how cases are so heavily negotiated pre-filing or not filed at all. And then when they're filed, they seem to be so pre-negotiated and pre-packed. I mean, you did Belk in 21 hours, I believe?
18.
I'm sorry.
There you go.
Okay, again, misinformation in the press that we're off by 3 hours.
Yeah.
And I know that your firm just did CWT in that case. Do you think that's the trend we're going to see? Because it certainly impacts the different levels that many of us in the industry access or get involved in cases and where we really can be useful or not.
Well, I think it's interesting because there's a lot of opponents to these expedited restructurings that are purely balance sheet restructurings. And what people don't appreciate is that unsecured creditors, trade vendors, your ordinary course participants in a company are getting paid in full in all these cases. And that's the reason why they can go so quickly, because you're able to build consensus amongst the balance sheet creditors. And anytime that you can reduce the administrative costs of a Chapter 11 and ease the company's ability to get in and out of Chapter 11, it totally makes sense. And I think it's something from a trend standpoint that's important because it demonstrates that you can utilize effectively the benefits of the voting rules under the Chapter 11 code to expedite a balance sheet restructuring and ensure that business continues, uninhibited. And I think it's certainly a trend that we'll see. Lots of people now these days say, I want to get one of those pre-packs. The reality is you can't buy it at Walmart or Target. You have to go out and negotiate, and it takes just as long to negotiate one of those transactions as it does a traditional Chapter 11 case where you file, create a business plan, and then negotiate. And that's kind of few and far between. That was 20 years ago, and we really haven't been seeing that all that much. So I think the trend will continue.
Okay. Now, Josh, it's so great seeing you, and I remember when we entered, I said, gee, you're wearing a suit, and I realized I've seen you in a suit a lot.
Half a suit.
Yeah, half a suit a lot. Because of Zoom, you think that's going to be the trend also in cases, and is that going to impact the practice?
It's interesting. There's a bunch of courts that have entered case management protocols as of late. Judge Sanchi entered one. Judge Isger and Judge Jones entered one in Houston. First day hearings are now going to be pretty much in all circumstances via Zoom. When there's live testimony, I think there's a lot of judges that would prefer to see the witness on the stand in the courtroom. And so I think it's going to be one of those things where everyone's just going to kind of deal with it on an ad hoc basis. There's certainly an element of being in court and seeing people around and getting that feel that you just cannot get on Zoom. And I think people, understand that and miss that. But, as we sit here today with new variants coming out all the time, it's unclear when it's going to return back to normal and what that new normal is going to be. But I think people welcome getting the opportunity to get back to court.
So like years ago, the suit industry is really going to be down, and the pants industry is going to be killed completely.
That's quite possible.
Okay. At any rate, well, appreciate the 30,000-foot overview. I did not give someone a chance to ask if we missed something on 30,000-foot level, but Josh and is going to be here for most of the session, and we're going to move on to Steve. So if there's any major question, we should ask right now. But otherwise, that was our introduction.
Yeah,
I'd like to introduce Steve, have Steve Gidemo get up here to do his annual overview, which everyone always looks forward to. And it's always a highlight. For one reason or another, it's always the highlight. And
got it. All right. Yeah, because Okay. I'm Steve Gidemo, and I think it's my 26th year, and I'm once again happy to be here and happy to see people again. So last year we did it through Zoom, and just did it at my home, I guess. And it's so much better to be in person. Josh just mentioned right now the word normal, and I had a slide prepared starting with that, which is called the adjusting to the new normal. And obviously with vax mandates, open borders unvaxxed, loss of energy independence, looting, Cold War with China, high inflation, backlog ports, the problems with the FBI, DOJ, and a new potential COVID variant. Can the American dream hold? And obviously, I think that's actually important. Everybody in the room here. Josh was talking about, or Howard was talking about how we have a lack of bankruptcies, and I have two thoughts on that, two comments on that. Is that I agree with the government stimulus that certainly hurt the retailers. It helped the retailers. It hurt the retail bankruptcies. So it hurt some of the people in this room. But it definitely was, the two were directly attributable in our view. And but the other thing is the lack of IPOs and deal flow, which Howard also alluded to. He talks to the M&A guys about lack of deals. If we don't have a vibrant IPO market, we're not going to have the capital creation, the entrepreneur activity that actually in some ways leads to the bankruptcies. How many times have we seen an industry, erupt and create something new? One just comes, trying to think of one off the top of my head, and next thing you know, actually one that's coming is the marijuana industry, where you have all these new entrants, and eventually there's going to be consolidation. There's going to be bankruptcies. I mean, obviously right now some are very small industries, small companies, but that's an area that's going to be ripe for consolidation and bankruptcies a couple years from now. But again, it's because of the capital formation that's occurring right now. Depending on this, how do we get to the next slide? Just keep pressing. Okay, great, thank you. So I titled this one, Biden Vision 2021. It's a year dominated by one man. I know people say that the previous 4 years was a year dominated also by one man, but this was a different one man dominating this year. So we had the border open, we got the migrants coming in, and then we have a U.S. labor force that declined from 158.6 million in 2019, that's pre-COVID, to 154 right now, which is sort of the snapback. So it's down about 3%. That's not too bad. And here we pick up Harold's point. While the COVID stay-at-home checks wrecked the work incentives, leading to 10.4 million jobs to go unfilled, with 7.4 million known unemployed. And again, the way the government counts unemployed, if you don't self-identify, you're not really known as an unemployed person. So the actual number probably is bigger. but that's historically always been the case. So closing the Keystone Pipeline, which I'm going to talk about here, which carried oil to Canada, but now the administration is bringing in oil from OPEC and Russia while urging OPEC to pump more, and we'll talk about that a little bit. That actually, in an indirect way, has probably hurt the creation of oil and gas bankruptcies, because it's led directly, which I will show you, to higher oil and gas prices. And one thing that is, I want to talk a little bit more about, but just keep, it's not yet such an issue, but it is going to be an issue, is this, every year I've been up here for the last 10 years talking about this quantitative easing, and the Federal Reserve Powell has come out and said that he is going to unwind quantitative easing. And again, we talk about this every year. The quantitative easing is when the Fed issues Treasury notes and then buys them themselves. So if those of you who have a printing press in your basement and can do that at home, it's a really wonderful thing. I've tried that a few times. It works a little bit for the short term, but the Treasury is the only one really that can get away with that. But the problem is there's no natural buyer for those Treasuries, and therefore it creates an excess supply of money, which ultimately is going to lead to inflation. We've been saying that for a number of years, as many other people have. So somehow we've had this in a sort of a deflationary period that we've had for the last 6 to 8 years. Where there's been, more goods chasing buyers. Now we have a situation that's the opposite of that, and we'll see if it's temporary or long-term. The quantitative easing has gotten away with that in a deflationary period. In an inflationary period, it's going to be a problem. But Powell has said that he's going to that he is going to start restricting that. The government has been printing about $120 billion a month, and that's down from higher levels. And now he said in November and December, so this month that's just ending, and next month it's going to go down to $15 billion, which, to just give you numbers, I mean, $1.2 billion a month, $120 billion a month is about $1.5 trillion a year. $15 billion a month is about $200 billion a year. It's a big difference. It's $1 trillion difference. And if you remember, a couple years ago, we talked about the contraction. If you take it out of the money supply, there's about a 4 or 5 time multiple on government spending. So that's going to have an impact in sort of a $4 trillion impact on liquidity, which people will feel that. So that's something to watch. So, okay, can asset prices stay up with so many cracks in the foundation? Has the stock market adjusted to the new normal? Now, before you jump ahead to the COVID variant that wrecked the market on Friday, that's the next slide. So this is sort of the new normal pre-Friday. So interest rates remained low. The 30 years mostly ranged from 1.9 to about 2.05. It was a pretty steady range. I mean, if you look at the last year, it's a little bit higher on both ends, but they're really that's almost 11, 12 months ago. But, pretty much it's been a tight range, which has helped stabilize the markets. Inflation, but inflation has jumped 6.2% in October from 1.8% in 2019. Again, it could be just a monthly variation, seasonal variation, but it is the highest inflation rate since 1991. In 1991, the 30-year Treasury average, the average Treasury yield was 8%. Okay, with now about $15 trillion of debt that is clearly on the books from all the spending of the last, say 10 years, we have an interest rate on the long term of about 2%. If that were to go to 8%, we don't know that world, but everybody in this room would be very busy. On day one, it's so fun to be contrarians, right? On day one, Biden canceled the Keystone Pipeline, stopping the inflow of oil from Canada. So the West Texas crude, that's the WTI, West Texas Intermediate crude, today is $78.33 a barrel. OPEC oil is $80.75 a barrel, and Canadian oil is $59 a barrel. And now, why is that? It just comes back to a basic thing of geography. People always ask, the first real port we had in the United States was up in Boston, right? Of course, because that's the Pilgrims, the first real colony developed. Then they moved south down to New York. The reason New York became such an instrumental port and Boston basically a third or fourth tier port is because New York is the first major port that doesn't freeze during the winter. And that's such an important issue, and it actually plays into the Canadian issue, right? Because Canada doesn't really have any deep water ports that can move oil out 12 months of the year. The first real port that they could gain access to is Seattle, and good luck trying to get oil being sent out of Seattle on the west side. On the east side, Quebec, I mean, you can't get it out of, Boston is, again, not a port that's always open to continuous supply lines. So as a result, some clever guys a few years ago came up with this Keystone Pipeline to move this low-cost oil that's basically trapped. It's a prisoner of geography into the United States where, one, we can use it, and second, it could then reach other ports and be shipped out if that was the dynamics of the day. So now, but by not doing the Keystone Pipeline and getting access to the $59 oil in today's prices, we have $80 oil or $82 oil. So we're forcing U.S. to pay more for oil, and that, ironically helps the gang of bad guys, Russia, Iran, and Venezuela, even though Venezuela has not really Iran and Venezuela have not been able to take advantage of it because of other reasons, structural issues, but it does help them because the prices are at least higher. And obviously we all know if you drive a car, you know that the gas pumps are up about 35%. I'm using a Pennsylvania average. You could get higher numbers in California or even in New York City. Retailers and manufacturers reported strong sales gains year over year, and that's shown up in the stock market as consumers recover from the COVID year and start returning to normal. And again, it's Josh and Harold's comment about the COVID checks, which have allowed consumers some extra spending money, which they have spent. But will the year-over-year growth carry into next year? And again, for people in this room, that is something to keep an eye on. Obviously, we do have the year-over-year increase against a poor year from last year. So the stock market, and sometimes the equity guys are ninnies sometimes. They look at, oh my gosh, we have 15% growth this year, and next thing you know, the models all say 15%, and boom, the stocks are up to the moon. Even if they go from 15 and tail it back down to 10 or 11, that's tremendous growth. But if the 15 is completely artificial, the model should say 2%, and that might get you a different stock valuation. But now, again, this is all pre the new variant. So now it leads to this new South African COVID variant. Will it be a growth killer? And on Friday, the stock market thought so. The chaos at the border remains what it remains. So if the Omicron variant from South Africa hits the U.S., it will likely lead to a new round of lockdowns. That you don't need me to tell you. You're seeing that on the front page everywhere. Europe already is on that page. I thought that was the front page of the Journal this morning talking about that. This will close businesses and hit airlines, cruise lines, restaurants, movie theaters, and local shops hard. These are the ones that got really hammered last year, and we have a couple slides on that. But everybody in this room knows that, right? So, and actually the stock market knows that. And last year we didn't know that. We didn't know. We kind of guessed that these would be the guys that are going to hit, but now we know how hard they get hit and how fast they bounce back. So the decline. I'm jumping ahead to the stock market, will decline, but probably not the same 36% decline that we saw this year. So if this new COVID variant comes in and it sticks and there's lockdowns, I would expect the market to certainly decline, but it may not sell off as much as we saw last year. On a positive side for restructurings or avoiding bankruptcies, bond yields will collapse as the U.S. will move into a second no-growth period. If there's no growth, then getting a 1 or 2% return on your bonds is an excellent return, right? Because you're at least getting something, whereas you're not competing against the stock market that's up 15%, and therefore you're demanding, and capital flies into the stock market. If capital has nowhere else to go, they're going to stay in the bond market. One thing that's out there is that Pfizer is rumored to be near, and I know a lot of people in this room know it, particularly if you read the papers every day, Pfizer is rumored to be nearing a drug that directly attacks and killed the COVID virus. And I heard somebody say that one of the things that Fauci did during the HIV years was he focused on vaccination and on the immune system. And what really turned the tide on winning the war against HIV was coming up with drugs that actually killed the virus itself. So on the one hand, we have building up the immune system, that's why everyone in the room is vaccinated. We've built up our immune system, but none of us have overtly killed the virus, right? Except if the immune system is, the T cells are attacking the virus. But a drug will go right after the virus, and that's what Pfizer is supposedly rumored to have. It's a drug, not a vaccine, and if that comes in and it's effective, that will be a game changer. And maybe the Pfizer stock doesn't even reflect that. But now the question is, with this new Omicron variant, if that's going to be enough. I mean, and if that is that tailored enough to kill that virus. So the market showed its fear of Omicron variant on Friday. We're live over here, right? Every year, it seems like the world makes news on Friday after Thanksgiving because they know we're not paying attention. So on Friday, but we're paying attention. So the market reacted on Friday. Dow fell about 1,000 points, about 2.5%, and it was the worst day loss in over a year. The macro environment 2021. The demand, I call it bounced back better, right? Who can do better than that? So the new COVID variant may lead to worldwide shutdowns. Okay, but that's current time here. So the GDP percent, and these are OPEC forecasts, actuals and forecasts. OPEC does a good job because they can't be that political. They're supplying oil to the world, and they don't really care. It's like, hey, if you don't like our opinions, don't take our oil, right? But some of their research reports are really kind of non-political, and so they're saying that China's growth for this year was expected to be 8.3%. Next year, it's expected to be down 5 to 5.8, which is one of the lowest ones I've ever reported on this thing in 25 years. And at the second derivative level, that's like a decline of 30%. So that's something economists would look at. India, 9% growth, going down to 6.8, which actually seems India may be actually a stronger economy than China at this point. The Eurozone has been flat, but they don't grow anyway, so it's 5.1 to 5. Who knows, right? Who cares? The U.S. 5.5, and their OPEC is suggesting that we'll be at 3.3 next year. And Japan is flat, and Russia is only curious because of the gas and the gas effect. They're the largest exporter of natural gas, and they have a pipeline going into Germany, as everybody knows. But the OPEC report said something that I thought would be interesting to quote, and it says, but mounting challenges in the Chinese economy point to a rising downside risk. And we've been hearing that for a number of years about these Potemkin villages of real estate developments where you have entire cities that have like no inhabitants, but $100 million of spending on empty buildings. And that day is going to come home to roost, and OPEC is sort of saying that there may be some rising downside risk. And we'll talk more about that. Does China really have the economic advantage over the United States? I mean, I hear every day how much of a superpower, China is against America. They're the next rising superpower. I mean, Jamie Dimon made... It's so much fun to see these guys. Oh, I'm Jamie Dimon. I'm the world's perfect human being. And he makes a comment that gets some, that is very truthful. He says to some question, Chase Bank will outlast communist China. Those of you may have missed that. Some may have missed that over the holiday. But he says that about a week ago, and of course he's had to walk that back, right? And but maybe he's right? So if he is, this slide suggests that there's something there, right? So, oops, not that slide. Do I go back? Is there a way to go back? That one. Sorry, the one you just had. That one. Thank you. So here, this is this is what everyone thinks about the companies in each of these respective economies. So, of course, the Dow Jones is not just America. It's a worldwide, these companies, worldwide corporations. Hang Seng is much more China-centric. But the Dow Jones last year at this conference was at 29,000. Now it's at 35,000. It's up 17%, 16.7. Hang Seng last year at the same conference, 26,000. All the numbers are almost similar. And they're down at 24%. They've lost 10% versus our gain of 16%. And the buying power in the U.S. hit a high in May of 2020, right after COVID was announced, or a couple months into the COVID, and that was the RMNI was 7.17, but it's continued to fall as China's defended its yuan. Decreasing U.S. buying advantage, but at a cost to China too, as their goods become more expensive. And you can see here, a year ago it was at 6.6, and now it's at almost 6.4, and with a 3% decline. Now, in theory, that's our buying power is being eroded, but it's also making China more expensive, and that's not good for a country that has 1 billion people that need to work. So going back to the crude oil, I put a nice little slide here. You got Canada up there at 59.53. The Brent, which is the North Sea oil, is 82. Saudi Arabia, which has also an advantage because it's a nicer, sweeter oil, it has less sulfur in it, so it's easier to refine and therefore is a very sought after crude oil, is at 80.75, and the West Texas Intermediate is almost similar, still is not as good as Saudi, but it's similar, and it's at $78. Now, some of the differences are going to be transportation costs, because to get it from Saudi Arabia to the United States, you got to get it over that ocean, and if you're going to the West Coast, you got to get it into through those ports, presumably. And Canada's sitting right there, basically prepared to feed the world's largest economy, and right now that's been closed at least for the next 3 years. So the Canadian prices are 26% lower than OPEC prices, and let's see. Okay, so this is a little bit conceptual. And it's not exactly fits the oil industry, but it's a good concept. The theory of marginal pricing in commodity industries is that if there's 1 ton too many to sell, then the price collapses because everybody's trying to sell their 1 extra ton or that extra ton. But if there is 1 ton too few, everybody's trying to demand because they can't run their factories if they don't have that 1 extra ton, and then the price soars. This is particularly true for very environmental sensitive things like sulfur products, where you can't dispose of it. So if you have one too many, everybody's trying to sell it at any price, so they don't have to, pay expensive levels of remediation to get rid of it. But at the same time, the reason you're making those products is because it's so crucial to something else in the industrial supply chain. So if you don't have it, the price soars. Now, oil's not exactly like that, but keep that in mind, right? So if oil, and I'll say oil is such an industry, but that's a little exaggeration, but not much. If the U.S. were importing oil from Canada, demand of OPEC oil would drop. That would be true, and prices would collapse, and they would go, meaning they go lower. So at a $65 per barrel oil price right now instead of this $82 with Canadian oil, because I'm saying that if we were importing it at $55, and again that's today's prices because there is no Keystone Pipeline, we'd probably be at $65 oil right now because the U.S. would not be having to import. We would be getting it directly from Canada. And that could save U.S. consumers about $124 billion a year. And that's the 82 minus 65, the 82 from the other slide, times 20 million barrels a day. I mean, unlike the U.S. Energy Secretary, I actually do know that number. It's actually 19.7 barrels a day we use. And at 365 days a year because it's every day, 24/7, and so it's 124 billion. So that's $500 billion over 4 years. So that's an undisclosed tax on U.S. consumers, and we're seeing that at the gas pump. And here's just a summary again of the OPEC production decline. OPEC's all the major producers of oil, and the caption is OPEC's production has declined, and U.S.'s has boomed through this year. So if you go to the first column, 2014, I put this up, I guess that's 7 years ago, and Saudi Arabia is at 9.7 million barrels a day. These numbers are, I dropped 1,000, so it's 9. That's per day, every day. And OPEC was at 30.7 million a day, and now they're at 27.5 million per day. Russia has been consistently at 10 million a day, and now they're at 10.8. They're at 10.2 to 10.8. The U.S. in 2014, because we sort of had an anti-fracking policy at the time, we were at 8.7 million a day, and now we're at coming off this number will be lower next year, is 17.6 million barrels a day. So an increase of 8 million barrels a day. We have basically been the largest increaser in oil production in the last 5 to 7 years. China, interestingly enough, is on the chart, and they've been pretty flat. They don't really have the world resources to make oil, but they have some. It's interesting. Iran. That went from 3 million a day to now they're only 2.5 million a day. That was some of the in 2019 hit their low because that was the sanctions, and then Venezuela, because their economy collapsed, went from 2.7 in 2014, and now they're at under 1 million per day. And there's no capital going into Venezuela because of what's going on there. So once they change their policies, that should go back up to the 3 million a year. Okay. So then I say the Biden vision, build back bituminous, if I can say that. Coal plants being built back bigger in China and India, while the nuclear remains an underused opportunity. And China, you can see these are operating coal plants, 1 million operating coal plants, and they have plants in CONS is construction, ANNO is announced, and then PER is permitted. So coal plants in construction, announced, or permitted is another 260,000 coal plants. So they are going to be the largest producer of coal, and they have 52 nuclear reactors against the U.S.'s 93, and their basically nuclear percentage of electrical use is about 5%. U.S. is almost 20%, but that may decline as these nuclear reactors start getting mothballed. The U.S. has no coal plants in production, in construction, announcement, or permitting, and we're right now at 232, and that number is going to go down lower. It's interesting that Indonesia is building, Japan is building coal plants, Russia is building only a modest amount of coal plants, and that's that's our new wave energy. The tech extends its dominance. There was an interesting story about how Facebook had this 3-hour outage the other day, about 2 months ago, and everyone's making it was such a big front page news story. You're like, what's the big deal? You're down, your servers are down for 5 hours. Who cares, right? Well, South America cared because it turned out that's basically the telecommunications of the entire continent. Or I'm exaggerating a little bit, but everybody in South America tends to use WhatsApp. And here's what's the power of this WhatsApp. So Verizon makes 800 Verizon customers, and it's a worldwide company. They make 800 million calls per day. But WhatsApp users send 100 billion messages per day, using 800 billion minutes a day. And some of that's phone calls, a lot of it's messaging. And WhatsApp has 2 billion active users, which is 30% of the world's population. And it's owned by Facebook. So, I mean, 1/3 of the people are using their telecommunication system. And everybody knows the story about Amazon with the Washington Post. And AT&T owns CNN, is looking to sell it. I mean, that'll be a transaction announced next year, perhaps. Comcast, the cable company, owns NBC, MSNBC, and CNBC. And for the life of me, once I realized this, and I've known this for a while, I still don't understand why all the other cable networks like Spectrum and so on allow Comcast to get away with that. And they should just, because they could also just push back and drop those stations because it's run by a competitor, owned by a competitor. And Google is dominant, obviously, in news and information, but now it's dominant in going into entertainment, as it's taking on Netflix, and Amazon's also taking on Netflix in the spinning whatever that I forget what that is. The quick stores. So we talked about the retailers to recover. I guess Josh and Howard were talking about that. There were no bankruptcies of retailers in July and August of this year, and that's significant because you always have the Christmas shipping coming in September, and the trade vendors have to make a decision: are we going to ship into a Christmas season to this retailer or not? And if we don't do it, I mean, if we do ship and then they file for bankruptcy, we'll never get paid for those goods. And this year they didn't do that. Right, so it's a bull signal for the retailers, and again, it probably goes back to the stimulus checks. But some of the retailers were on last year's chart have emerged. Guitar Center filed for an IPO. Mattress Firm filed for an IPO. Claire's filed for an IPO. Hertz Car Rental is now publicly trading, though I think they might have filed in 2019, but maybe it was early 2020. Michael's Store, which was going to probably have to file, got a real boon by people staying home and doing handicrafts, and sold itself to Apollo Management. Party City, also rumored to be in trouble, issued $725 million in bonds and was able to retire bank debt. And GameStop, that short thing, the CFO and the company finally came to their senses and said, look, if it's going to be a $150 stock and we think it's a $25 stock, let's do what we're supposed to do and sell the high-price shares to pay off debt, which they did, which actually probably now makes it a $45 stock, even though it's much higher than that. So they did the right thing. If the market wants to give you that and you fully disclose the risks, you should, maybe the market knows more than you sometimes. So recovering from COVID. Last year I put up the slide of this Disney, the 10Q, compared 2019 to 2020. And just to go to the income, you had Disney made 1.6, that's in millions, so it's 1.6 billion against a loss of 4.5 billion for just those 3 months last year. And now it's 1.1 billion and for this year's quarter. So that's almost back to normal. Delta Airlines made 1.5 billion in 2019 for that same July-September quarter. Last year they lost 5.4 billion, and this year they're up to 1.2, which is almost the entire recovery of the income. But I'm more focused for an airline. You got to be more focused on the balance sheet. And here they had cash and equivalents of 21 billion. And then debt of 35 billion. So they raised cash to help them get through the panic. And now they're down to 13 billion in cash, but they've reduced debt to 28 billion. So if you deduct the cash from the debt, you got basically a net debt of 15 billion there. And last year they had net debt of about 14 billion. I would say that that's good CFO stewardship. And that's the way you got to handle a crisis if you can do it. Now they're benefiting because everyone wants to fly, but that's still fantastic financial management, in my opinion. Carnival Corp has a different situation. I'm not bashing the CFO here. It's a different situation. This is discretionary travel. And there last year, in 2019, it was 1.8 billion of profit and a little bit of cash and 11 billion of debt. But if you take the income of almost 2 billion into 11, it's only 5 times the income is 5 times your debt level. Debt is 5 times your income, roughly. Last year was a disaster, 2.9 billion of loss. And the cash, they did raise cash, but they increased their debt up to 23 billion. That's a net of 15 billion. Now the net's gone up to 24 billion, and it's really because the industry just has not come back. And so I just showed you 2 companies that their third quarter this year, their 3 months this year was very strong, and this is not. This is the same as last year, and it's and the stock is much higher. So this balance sheet remains a mess. But again, that's not the CFO's issue. It's not his fault. It's the industry's fault. It's the industry that he's working in. I'm going to have to skip through this out of time. We had some industry bellwethers, but the key thing here is the energy stocks led the way with a strong rebound, and there's only 2 red negatives on there. That's IP, that's lumber, which is probably stuck in port, and it's probably a reflection of all the furniture that's not being shipped that is stuck in port, because a lot of the lumber goes to China to be made into furniture and then comes back to the United States, and so that they could be definitely impacted by that. And the retailer Walmart probably had such a good year last year, and now the market is saying that maybe Walmart won't be so dominant, and that now the little guys will get their chance of return. So it's basically flat, but everything else is just off the charts strong. The hospital industry, the tech titans, by the way, have done great. Google up 65%, Facebook up 25%, Amazon up 12%, Apple up 40% with the new iPhone. I guess that's for them. The hospital stocks, I view this as a strong oligopoly. I'm interested to see, Tenet here that was a $3 stock about 5 years ago. Now it's a $75 stock. It has a tremendous IRR just over the last year as they've rebuilt and cleaned up their balance sheet and their company. And HCA, Community Health, has been great. And Universal Health is still struggling a little bit compared to its competitors, but the stock has not imploded. It's only down 6%. Drug stocks, Eli Lilly has a bunch of stocks in works for Alzheimer's and type 2 diabetes, and Pfizer is the one a lot of people are looking at. I didn't put it on during the last year, and so I didn't put it on this year, but that would be another one to watch. And J&J, as people in this room may know, is talking about doing a good bank, bad bank structure and taking the talcum powder and putting it into a corporation and then basically filing that for Chapter 11. So those of you who have contacts into J&J, though I'm sure they're already working on it, you keep an eye on that. And Matt Dundon, who'll be in my panel this afternoon, I think he might be actually working on some of that. So what to watch for in 2020? For the moment, the eyes of the investing world return to Omicron. I'm anxious to see the markets opening up in about half an hour, see what happens today. If inflation will eventually take its toll, but if demand dries up because of the variant, then we're not going to have inflation. Inflation will be tamed for the moment, with a day of reckoning still coming. The quantitative easing, we talked about it earlier. The congressional elections are coming up, and that could be a very interesting. And my summary there is 2022, like 2021, could be a very turbulent year ahead. In conclusion, pick your poison. A virulent COVID strain causing lockdowns, but lower inflation and lower interest rates, or freedom to live but high inflation, rising interest rates, and a slowing stock market. It's kind of right now, because of what happened on Friday, and we're adjusting in real time. It's like, wow, may be a tale of two cities, as I think Josh or Howard said earlier, and that's where I'm at. So thank you very much.